Hi everybody, this is Eddie Gabor, Managing Partner of Key Advisors Group, and today I wanted to share with you what we believe that the bond market and commodities market, what signal that is sending to the overall fourth quarter trade. I've been very vocal on my national TV interviews on Fox Business and other networks that we're pretty bullish in regards to the fourth quarter. We saw a lot of chop in the third quarter. Things were not great from a third quarter perspective. We really think a lot of that had to do with the Delta variant and changing the economic activity and consumer behavior because of those spikes. And now that it has dropped quite a bit in regards to rate of change perspective, we think the bond market, which we believe the bond market is smarter than the stock market and is more forward looking, that the bond market right now is signaling some pretty robust growth and an acceleration of GDP in the fourth quarter. And look, when you look at what the Fed has been saying, the Fed actually lowered their GDP for the fourth quarter. We respectfully think that that is wrong. We've seen a lot of analysts come out and predict a massive drop in the fourth quarter. One individual said a 20% drop back in September that he was saying was the start of this 20% drop that would go into the fourth quarter. We respectfully disagree with that. And then overall, I think consensus when you listen to the so-called talking heads is there's a lot of people that are positioned for defense right now because of their concerns in the fourth quarter. And we think the bond market is really sending a complete opposite signal. You know, a big misconception in our opinion is rising rates is bad for equities, okay? Now, I think you have to put in perspective where the rates are rising from. When you take a look at the 10-year bond, we're not talking about a 10-year bond that's going from 6% to 7%. We haven't even gotten close to 2% here in the last year and a half. So when the 10-year bond is at a very, very low rate and the rate of change is accelerating upwards, you have to put it in perspective that the top end of the 10-year in regards to where we've been has been just under 1.8. That is still a very, very low interest rate in our opinion relative to history. So when you see the bond market really move the way that it has, whether it's the 2-year or the 10-year, you're really seeing them move vertically. And the other interesting thing right now with interest rates is it's not just here in the US. Globally, interest rates have really, when you look at the chart, they've been moving vertical here over the last few weeks. And we think that is sending a very, very clear signal that the bond market is expecting a real acceleration in growth in the fourth quarter. So these folks that are coming out and calling for this 20% correction and this massive drop in commodity prices and a big drop in consumer confidence and consumer spending, the bond market, in our opinion, is telling them that they're dead wrong. Now, time will tell who's right. We are in the camp that the bond market is right. But again, this misconception that rising interest rates is bad for equities, in our opinion, is not very accurate. I mean, take a look at time periods when interest rates have been rising. A lot of times that rise has been due to growth accelerating, and that a lot of times has meant higher equity prices, right? You still have to own quality companies with good balance sheets and the same fundamentals that you've always been taught to follow. But this whole rhetoric of when rates are going up, you need to get the heck out of the market, I just don't know where that's coming from. And so we think the opposite right now. We think this rise in rates around the globe is really giving us a signal that the equity markets actually haven't priced in enough growth for the fourth quarter. That again is why we have really been increasing the risk since September in regards to our equity positions for clients, going a little bit more out of your low beta and increasing small cap exposure, increasing some large cap tech that we think can do well. And again, everyone's situation is different, so that's not a recommendation for you. I'm just sharing with you our broad opinion and what we've done to position for this, okay? So when we have the bond market signaling that rates are going up, not just here domestically, but around the globe, that's a very, very positive thing, okay? The other thing is what the commodities market is telling us right now, okay? If things were really cooling off economically, why are we looking at oil hitting highs that we haven't seen in a while? Why are we looking at commodities across the board hitting highs that they haven't seen? You do not, in my opinion, see this acceleration and increase in oil and natural gas and copper and corn and cotton. You name it, it's been going up. You do not see that type of price action on commodities if we are heading into a market crash due to a slowdown in GDP. Now, ultimately, will we see a slower GDP in regards to rate of change perspective? More than likely. We don't think it's in the fourth quarter. That'll be for another video in regards to how we think that's really going to play out next year. But my goodness, right now, in our opinion, when we're taking a look at everything from currencies to interest rates to what the commodities market is telling us, rates and commodities are telling us right now that we are going to see an acceleration in GDP. This is why we firmly believe that the reflationary trade is on and why we think consensus right now is wrong, okay? Because when you think back, just look at this year so far. The first quarter, we saw an acceleration in GDP. You saw rates go up. You saw commodities go up. Third quarter, we start to see things change. We saw commodities go down. Oil got into the mid-60s to high 60s. You saw rates really start to come down. And you saw that really reflected in your risk and reflationary trade. It did not work in the third quarter. And now in the fourth quarter, you have the complete opposite. So common sense, in our opinion, tells us that we are seeing a lot of, when you lift the hood up and look at the underlying factors that are happening right now in the currency market, in the interest rate market, and in the commodities market, that we're seeing a lot of the same things we saw in the first quarter. So in our opinion, you want to be long inflation if you have the right risk tolerance. You want to be long those things that are going to do the best in regards to a reflationary trade based on acceleration of GDP, okay? Now, we know we're not always going to have this Goldilocks type scenario in which you see this acceleration in GDP and consumer spending being so strong and the rates supporting it and currency supporting the thesis and commodities. But my goodness, you want to take advantage of these opportunities when they present themselves. And that's what we're doing right now as a firm. Again, time will tell if we're right. We're not always going to be right, but we just have to make sure we have a pretty good batting average or I won't be sitting in this seat for a long time, okay? So right now, this, in our opinion, is what rates and commodities are telling you as an investor, and I think you need to pay attention because it is giving you the playbook for what it believes is not priced into the market right now for the fourth quarter. And so we'll see if consensus is right in regards to deflation or if we are right in regards to reflation based on what we're seeing on rates and commodities. So that's it for today. If you have any questions, send it to me in my inbox and I'll make sure I address it in our next video. Thank you and have a great day.